Financial accounting, simplified explanation. Introduction. What is an account? An account is like a summary of money-related activities of a business. It records transactions related to people, e.g. customers, suppliers, assets, e.g. buildings, cash, income and expenses, e.g. sales, rent. Think of it as a history of financial activities for a particular person or item. Definition of an account. A record of financial income and expenses for a specific period. Double-entry accounting system. This system follows a simple rule. Every transaction has two sides. One account is debited and another is credited. For example, if a business buys furniture asset for $10,000 in cash, furniture AC asset debit $10,000, cash AC credit $10,000. Share where are financial records kept. All financial records of a business are stored at principal office or business location. Why keep financial records? Helps stakeholders, owners, investors, government see the financial health of a business anytime. Short trick to remember. Paste people, assets, cash, expense, D, double entry. Just remember pay to recall key concepts. This makes it easy to understand financial accounting basics. Meaning and definition of accounting, simplified. What is accounting? Accounting is the language of business. It records financial transactions and helps in analyzing and understanding a company's financial condition. Example: just like a doctor uses reports to check a patient's health, businesses use accounting to check their financial health. Purpose of financial accounting: records financial transactions, presents and interprets financial results, helps in decision-making for investments. Definitions of accounting. 1 AICPA definition. Accounting is the art of recording, classifying and summarizing financial transactions and interpreting results. 2 AAA definition. Accounting is identifying, measuring, and communicating economic information for better decision-making. Bierman and Durbin definition. Accounting means recording and communicating financial data. 4 RN Anthony definition. An accounting system collects, summarizes, and reports financial data of a business. Short trick to remember: presenting, recording, interpreting, decision-making. Just remember to recall what accounting does. Features of accounting, simplified explanation. What are the features of accounting? 1. Monetary transactions. Only records transactions in money terms. Example: buying machinery for $5,000 is recorded, but employee skills are not recorded because they cannot be measured in money. 2. Historical nature. Only past transactions are recorded. Example: last year's rent paid is recorded, but future rent is not recorded until paid. 3. Legal requirement. Companies must keep financial records, must prepare profit and loss account, balance sheet yearly. If business crosses a limit, audit is required. 4. External use. Used by outsiders like banks for loans, investors to check profits, suppliers to check business stability. Disclosure of financial status. Shows profit loss, P&L account, and financial health. 6. Interim reports. Financial statements are temporary reports updated every year. Short trick to remember. Short trick to remember: monetary, historical, legal, external, disclosure, interim. Just remember MH Letty to recall all features quickly. This makes it easy for exams. Scope, uses of accounting, simplified explanation. What is the scope of accounting? Accounting is useful for businesses in many ways, including forecasting, decision-making, taxation, fraud detection, and maintaining financial records. 1. Business forecasting. Predict future business trends using past and present data. A sports shoe company checks past sales and decides to start formal shoes manufacturing. Proper decision-making. Helps in important decisions like setting product prices, investment in new projects, increasing employee salaries, giving bonuses, dividends. 3. Correct taxation. helps calculate income tax, GST, customs duty, etc. Example, a company can avoid penalties by paying correct tax amounts based on financial records. 4. Replacing memory. Businesses do thousands of transactions daily. Impossible to remember all. Accounting records everything, so no need to memorize transactions. 5. Analyzing financial status. Profit and loss account shows profit or loss of the company. Balance sheet shows assets and liabilities of the company. Documentary evidence. Accounting records can be used as legal proof in court. Example, a company can show vouchers and invoices to prove a transaction. 7. Helping in realization of debts. Shows how much money customers, debtors owe and how much company owes to suppliers, creditors. Helps in collecting payments on time. Preventing and detecting frauds. A good accounting system prevents theft, fraud, and cheating. Example, if cash is missing, accounting records help find out who took it and where it went. Short trick to remember, BPCT read. B. Business forecasting, proper decision making, erect taxation, replacing memory, analyzing financial status, documentary evidence, detecting frauds. Just remember BPC to recall all points quickly for exams. Let me know if you need further simplification. Of accounting simplified explanation. What does accounting do? Accounting follows a step-by-step process to handle financial data, from identifying transactions to communicating financial information. While identifying. Find and select business transactions. Example, a company buys raw materials. This is a business transaction. Write down transactions in a book called journal. Example, if $50,000 is spent on advertising, it is recorded in the journal. Classifying. Group similar transactions under different heads in ledger. Example, all salary payments go under salary account. All electricity bills go under electricity expense. Summarizing. Convert transactions into a clear financial summary used by managers, employees, investors, and government. Analyzing. Find out financial strengths and weaknesses. Example, a company checks profit and loss account to know if it's earning enough profit. 6. Interpreting. Helps management understand financial statements and make future plans. Example, if profits are low, the company may reduce expenses or increase sales prices. 7. Communicating. Share financial results with stakeholders, investors, employees, banks, tax authorities. Helps them make informed decisions. Short trick to remember, IRCIC. Identifying, recording, C, classifying, summarizing, interpreting, communicating. Just remember IRCIC to recall all steps of accounting. Let me know if you need further simplification. Advantages of accounting, simplified explanation. Why is accounting important? Accounting helps businesses manage their finances, make decisions, and meet legal requirements. 1. Helps in management. Managers use accounting data to plan, monitor, and make business decisions. Example, a company uses sales data to decide whether to expand its business. Substitute to memory. No need to memorize transactions, as everything is recorded systematically. Example, instead of remembering each sale, the company records it in books. Comparative study. Financial statements help in comparing business performance over different years. Example, if profits were 5 lakh last year and 7 lakh this year, the company is growing. Settlement of taxation liability. Accurate records help in tax assessment, income tax, GST, sales tax. Example, a company must show proper accounts to the tax department to avoid penalties. 5. Evidence in court. Records act as legal proof in case of disputes. Example, if a customer refuses to pay, the company can use accounting records in court. Sale of business. Proper accounts help in determining business value for sale. Example, if a businessman wants to sell his company, buyers check the financial records. 7. Assistance to an insolvent person. If a person goes bankrupt, accounting records help explain financial transactions. Example, A failed businessman can use accounting records to settle debts legally. Short trick to remember. Management help, substitute to memory, see comparative study, taxation settlement, sale of business, assistance to insolvent. Just remember, Tessa to recall all benefits of accounting. Let me know if you need further simplification. Disadvantages of accounting, simplified explanation. Why does accounting have limitations? While accounting is useful, it also has certain drawbacks that may affect its accuracy and reliability. 1. Non-monetary items overlooked. Only money-based transactions are recorded. Example: employee loyalty, brand reputation, or goodwill is not recorded in accounts. Original cost issue. Fixed assets are recorded at their original purchase price, not their current value. Example: a building bought for 10 lakh in 2000 is still recorded as 10 lakh, even if its value is now 50 lakh. Possibility of manipulation. Profits can be manipulated by not including expenses like R&D and advertising. Example: a company may delay recording expenses to show higher profits. Fourth, based on estimates. Some values are estimated, not actual, leading to possible errors. Example: depreciation, bad debts, and stock values are often based on assumptions. 5. Inconsistency in accounting rules. Different methods lead to different results, affecting financial accuracy. Example: if a company uses non-SLM, straight line method, 1 year, and WDV, written down value, the next, profit figures may vary. Short trick to remember. No, non-monetary overlooked, original cost issue. B, based on estimates. E, AZ manipulation, inconsistency in rules. Just remember to recall all limitations of accounting. Let me know if you need further simplification. Accounting Information System, AIS, simplified explanation. What is AIS? An accounting information system, AIS, is a system that collects, processes, stores, and provides financial information to users. It helps businesses manage their financial data effectively. How does AIS work? 1. Inputs, data collection. Raw data is collected like invoices, receipts, and transactions. 2. Processing, data storage and calculation. The accounting system processes the data using software and databases. 3. Outputs, reports, and decision-making. The processed data is used to generate financial statements, tax reports, and management reports. Functions of AIS. Automates transactions, no manual entries. Data is automatically recorded. Stores financial data. Keeps records of sales, purchases, and expenses. Provides useful reports. Helps in decision-making for both internal managers and external users, investors, regulators. Ensures legal compliance, generates reports required by tax authorities and other regulatory bodies. Short trick to remember. IPO, input, collecting transaction data, processing, storing and calculating data, output, generating reports. Just remember IPO to recall the working of an accounting information system. Let me know if you need further simplification. And objectives of accounting information. What is accounting information? Accounting information refers to financial data recorded and processed by an accounting system. It helps businesses track performance and make better decisions. Objectives of accounting information. 1. Communicate information. Shares financial data with owners, creditors, employees, investors, and tax authorities. Helps in decision-making by providing relevant financial reports. 2. Helps in decision-making. Keeps a systematic record of transactions to support business decisions. Since human memory is limited, records help in analyzing trends over time. 3. True picture of organization. Shows the actual performance of a company. Profit and loss account helps attract investors by showing earnings. 4. No financial position. Balance sheet helps in understanding assets, what business owns, and liabilities, what business owes. Gives a clear view of financial stability. Find profit or loss. helps determine whether a business is making a profit or a loss. Investors and stakeholders use this data to assess business health. 6. Manage risks and uncertainty. Helps in identifying financial risks and preparing for unexpected situations. Ensures stability by providing accurate financial information. Short trick to remember, CTOP FM, communicate information, true picture of organization, operational profit and loss, position of finance. F, facilitates decision-making, manages risks and uncertainty. Just remember CTOP FM to recall all objectives of accounting information. Let me know if you need further simplification. Users of accounting information, simplified. Who uses accounting information? Accounting information, especially financial statements, helps many people inside and outside a business. These users can be divided into internal users inside the company and external users outside the company. Internal users inside the company. 1. Owners, shareholders, partners, proprietors. They invest money and want to know the profitability, growth, and financial health of the business. They use financial reports like profit and loss account and balance sheet. 2. Management, top, middle, and lower levels. Uses financial data to make policies, set goals, and monitor business performance. Helps in budgeting, sales, production, cash, etc., to control expenses and plan resources. Employees want job security, salary hikes, and better working conditions. Helps in industrial relations between employees and management, e.g. salary negotiations. 2. External users, outside the company. 4. Creditors, suppliers, lenders. Want to know if the company can repay its short-term debts, liquidity. Check financial health before giving trade credit, delayed payments for raw materials. 5. Prospective investors, individuals, banks, finance companies, need to assess risk, returns, dividends, and growth potential before investing. Study profitability, dividend policy, and expansion plans. 6. Government agencies, tax authorities, CB or OCLB, MOTC, etc. Ensure tax compliance, legal regulations, and investor protection. Example, CB monitors stock market activities. RO checks company records. 7. Customers. Interested in pricing, quality control, and corporate social responsibility CSR. Want to know if companies follow ethical business practices. 8. Researchers. Use financial reports to analyze trends, improve business policies, and suggest reforms. Helps in developing better regulations and industry standards. 9. Foreigners, FDI, MNCs, joint ventures. Interested in financial statements before investing, merging, or acquiring businesses. Helps in international trade and global business decisions. Others, media, stock exchanges, political parties, entrepreneurs, trade associations. Track financial data to analyze business environment and economic trends. Example, stock exchanges monitor company performance to guide investors. Short trick to remember, OMI CPIG FRO. Owners and management employees, Reddit respective investors, investors G government agencies, foreigners, researchers, others. Just remember OMI CPIG FRO to recall all users of accounting information. Let me know if you need further simplification. Branches of accounting simplified. Accounting has different branches because different people need financial information for different reasons. The 3 main branches are financial accounting, past data, management accounting, future planning, cost accounting, cost control. 1. Financial accounting. What is it? Deals with past financial data, usually for 1 year. Focuses on preparing financial statements like profit and loss account, profit loss of business, balance sheet, assets and liabilities at year-end. Key points. Follows GAAP, generally accepted accounting principles, used by external stakeholders, investors, government, tax officials. Focuses on recording and reporting, not decision-making. Example, a company publishes its financial report to show shareholders how much profit it made last year. 2. Management accounting. What is it? Future-focused. helps managers make business decisions, includes cost accounting, budgeting, and forecasting. Key points: does not follow GAAP because it's for internal use only, helps in decision-making, planning, and control, customized for a company's specific needs. Example: a company uses budgeting to plan expenses for the next year and make decisions about investments. Cost accounting. What is it? Focuses on calculating and controlling costs in business, helps in pricing products, reducing waste, and improving efficiency. Key points: measures costs like material cost, raw materials, labor cost, workers' wages, overhead cost, rent, electricity, uses different methods for cost analysis and control. Example: a car manufacturing company calculates the cost per car by analyzing material, labor, and production costs. Short trick to remember: FMC, financial accounting, management accounting, cost accounting. Just remember FMC to recall all branches of accounting. Let me know if you need further simplification. Basic terminology in accounting, simplified explanation with symbols. Accounting has many important terms that help in understanding financial transactions. Below is a simple explanation of key accounting terms. Assets. What are assets? Assets are things a company or person owns that have value. They can be used to pay debts or generate income. Formula: assets equals liabilities capital. Types of assets. Fixed assets, long-term assets used for business, not for selling. Tangible fixed assets can be touched, land, buildings, vehicles. Intangible fixed assets cannot be touched but have value, patents, trademarks. Current assets, cash or assets that can be turned into cash within a year. Examples: cash in hand, bank balance, stock, accounts receivable. Fictitious assets, not real assets but recorded in books due to legal reasons. Examples: preliminary expenses, advertisement expenses. Nash 2, liabilities. What are liabilities? Money or services that a business owes to others. Formula: liabilities equals assets, capital. Types of liabilities. Current liabilities, short-term debts to be paid within a year. Examples: salaries payable, bills payable, bank overdraft. Long-term liabilities, debts that are due after 1 year. Examples: bank loans, bonds, debentures. 3. Capital, the money invested by the owner in a business. Formula: capital assets liabilities, also called owner's equity. 4. Proprietor, the person who owns and runs the business. 5. Drawings, money or goods taken by the owner for personal use. Example: using the company's car for personal travel. 6. Revenue, money earned by a business from sales or services. Expenses, money spent by a business on operations like salaries, rent, raw materials, etc. Income, profit after deducting expenses from revenue. Formula: income equals revenue expenses. 9. Losses, when a company's expenses are more than its revenue. Example: loss due to fire or theft. 10. Purchases, buying goods or raw materials for business. Purchases return, returning defective or extra goods to the supplier. 11. Sales, selling goods or services to customers. Sales return, when customers return goods they don't need or are defective. 12. Stock inventory, goods available for sale or production. 13. Debtors, accounts receivable, people, customers who owe money to the business because they bought on credit. Creditors, accounts payable, people or businesses to whom the company owes money. 15. Solvent, a business that has enough assets to pay its debts. 16. Insolvent, a business that cannot pay its debts. 17. Vouchers, documents that prove a financial transaction took place, e.g., receipts, invoices. Invoice, a bill given by the seller to the buyer mentioning details of the sale. 19. Receipt, a document that proves money was received. Capital profit, profit from selling assets at a price higher than their original cost. Example, selling a company's old machine for 5 lakh when its cost was 3 lakh. Memory trick. To remember key accounting terms, use the word asset pilots, assets, capital, income, debtors, purchases, insolvent, liabilities, owner, proprieties, sales and purchases. This will help you recall major concepts in basic accounting terminology. Accounting Principles, GAAP and the Accounting Environment, 1.2.1, Meaning and Definition of Accounting Principles. What are accounting principles? Principles equals basic rules that guide actions. Accounting principles equals rules and guidelines for recording and reporting financial transactions. GAAP, generally accepted accounting principles, standard rules that accountants follow. Different countries have their own GAAP. Definitions of accounting principles. AICPA, American Institute of Certified Public Accountants. Definition. A principle is a general rule or law that guides accounting actions. Simple definition. Accounting principles are rules followed by all accountants while recording financial transactions. GAAP definition. GAAP consists of rules developed from experience and practice that are widely accepted in accounting. CHAP key points to remember. Accounting principles ensure consistency and accuracy in financial reporting. GAAP rules differ across countries but serve the same purpose, standardizing accounting practices. Shortcut to remember, generally accepted principles. This will help you recall that GAAP equals generally accepted accounting principles. Features of accounting principles. 1. Based on general rules. Accounting principles are formed from rules, conventions, and assumptions that are accepted by accountants, auditors, managers, and government agencies. These principles are not perfect and cannot be 100% correct, but they provide a common guideline. 2. Developed through logic and experience. Accounting principles are not laws, but they are created based on logic, experience, and practical needs. They are designed to meet the requirements of stakeholders, like shareholders, creditors, tax authorities, and regulators. Widely accepted. These principles are recognized globally by businesses, auditors, and financial authorities. Companies can sometimes make minor modifications to suit their specific needs, but the core principles remain the same. Shortcut to remember. Law, else, logic, and experience, accepted widely, working on general rules. This will help you recall that accounting principles follow law, logic, acceptance, and rules. Need, utility of accounting principles. Why do we need accounting principles? Accounting principles are important because they ensure consistency, reliability, and comparability in financial statements. 1. Provides accurate and authentic data. When financial data is prepared using accounting principles, it shows a true and fair picture of the business. Example, if two companies use the same method to record profits, their results will be reliable and accurate. 2. Makes accounting a science. Since accounting follows rules and principles, it becomes a systematic and logical process like a science. Example, just like in science, if you follow the same method, you get the same results in accounting. 3. Ensures reliable and comparable statements. Financial statements prepared using accounting principles are more meaningful and trustworthy. Example, investors and banks trust financial reports that follow standard principles. 4. Helps in comparing companies. If all companies follow the same principles, their financial results can be compared easily. Example, comparing Company A and Company B is possible only if both use the same accounting rules. Shortcut to remember, fact. Financial data is accurate. Accounting becomes a science. See comparable financial reports, trustworthy statements. This will help you recall that accounting principles provide fact, fairness, accuracy, comparability, and trust. Limitations of accounting principles. Why do accounting principles have limitations? Even though accounting principles help maintain accuracy and consistency, they have some limitations that affect their universal application. 1. No fixed set of principles. There is no single rulebook that applies to all businesses in every situation. Business conditions change, and accountants create new principles as needed. Example: a startup and a multinational company may need different rules to record transactions. 2. Not universally accepted. Accounting principles are called generally accepted, but are not followed by all businesses. Since businesses are different in nature, they may prefer different accounting methods. Example: even two companies in the same industry may use different rules for recording revenue. 3. Differences in application. Even if two businesses follow the same principle, they apply it differently. Accountants may use different methods for the same accounting task. Example: depreciation calculation. Two accountants may choose different methods, straight line versus reducing balance, leading to different results. Has shortcut to remember: NADNN, O fixed rules, new principles created. A, agreement missing, not universally accepted. D, different applications, same principle, different results. So remember that accounting principles have NAD, no fixed rules, agreement issues, and different applications. Classification of accounting principles. Why are accounting principles classified? Accounting is based on fundamental assumptions and rules called Generally Accepted Accounting Principles, GAAP. These principles help businesses maintain accurate and reliable financial records. Accounting principles are divided into two main categories: accounting concepts. These are basic assumptions that guide how financial transactions should be recorded. They ensure consistency and accuracy in financial statements. Example: going concern concept. A business is expected to continue running in the future, so assets are not recorded at liquidation value. Accounting conventions. These are practices developed over time based on experience and convenience. They help in decision-making and maintaining fairness in financial reporting. Example: conservatism convention. Businesses should record potential losses but not potential profits unless realized. Shortcut to remember: CC, concepts and conventions. C concepts, basic assumptions. Conventions, practices based on experience. So always remember, CC, concepts and conventions form the base of accounting principles. Concepts. What are accounting concepts? The word concept means a general idea or assumption. In accounting, concepts are basic rules or guidelines that help in recording financial transactions consistently and accurately. These concepts ensure that all businesses follow a common standard, making financial statements easy to understand and compare. Important accounting concepts. 1. Separate entity concept. A business is considered a separate entity from its owner. Personal and business finances should not be mixed. Example: if a business owner withdraws cash for personal use, it is recorded as drawings. 2. Going concern concept. A business is assumed to continue operating indefinitely. Financial statements are prepared under the assumption that the company will not shut down soon. Example: assets are recorded at cost price, not liquidation value. 3. Money measurement concept. Only transactions that can be measured in money are recorded. Non-monetary aspects like employee skills are not recorded in financial statements. Example: a company's brand reputation is not recorded, but its revenue is. 4. Accounting period concept. Financial performance is measured for a fixed period, monthly, quarterly, yearly. Helps in comparing financial results over different periods. Example: a company prepares annual financial statements. 5. Cost concept. Assets are recorded at their original purchase price, cost, not current market value. Example: a machine bought for 5 lakh in 2010 is still recorded at 5 lakh, even if its market price is now 8 lakh. 6. Dual aspect concept. Every transaction has two effects, one debit and one credit. Forms the basis of double entry system of accounting. Example: If a company buys furniture for $10,000, its cash decreases, credit, and furniture asset increases, debit. 7. Accrual concept. Income and expenses are recorded when they occur, not when cash is received or paid. Example: a company sells goods on credit in March but gets payment in April. The sale is recorded in March, not April. 8. Matching concept. Revenues and related expenses should be recorded in the same accounting period. Ensures accurate profit calculation. Example: if a company earns revenue in December but pays salary in January, the salary should be recorded in December's accounts. 9. Realization concept. Revenue is recorded when earned, not when cash is received. Example: if a company delivers goods in June but gets payment in July, the revenue is recorded in June. A shortcut to remember: SG EBITDA. Separate entity, G going concern, M money measurement, C ost concept, A accounting period, D will aspect A accrual concept, R realization concept. SG helps you recall all key accounting concepts easily. Separate entity concept. What is the separate entity concept? The separate entity concept means that a business and its owner are treated as two separate entities. This helps in keeping personal and business transactions separate, ensuring clear financial records. Key points to remember. The business has its own identity, separate from the owner. Owner's personal transactions are not recorded in business accounts. Capital invested by the owner is recorded as a liability for the business. If the owner withdraws money or assets for personal use, it is called drawings, not a business expense. Example: if a business owner invests 5 lakh into the company, this is recorded as capital liability in the business books. If the owner withdraws 50,000 for personal expenses, it is recorded as drawings, reducing the owner's capital. Shortcut to remember: SBOT, isness at drawings. SBOT helps you remember that a business is separate from its owner, and withdrawals are recorded as drawings. Concern concept. What is the going concern concept? The going concern concept assumes that a business will continue to operate for a long time without shutting down. This means the company will use its assets, pay its liabilities, and keep running normally in the future. Key points to remember. A business is expected to continue operating in the foreseeable future. Financial statements are prepared assuming continuity of the business. Long-term investments, loans, and contracts are made based on this concept. Depreciation is charged on fixed assets because they will be used over time rather than being sold at market value. Without this concept, assets could not be classified as fixed or current, making financial statements unclear. Example: a company buys a machine for 10 lakh and expects to use it for 10 years. The machine is not recorded at resale value, but its cost is reduced gradually through depreciation each year. If a business gets a loan from a bank, the bank assumes the company will continue operating and will repay the loan over time. Shortcut to remember: goal, going O. Proration. H, assets, used, not sold. Business continues to repay. Goal reminds you that the business keeps running, using its assets, repaying loans, and making long-term plans. Money measurement concept. What is the money measurement concept? The money measurement concept states that only those transactions which can be expressed in money, rupees, dollars, etc., are recorded in accounting. If something cannot be measured in money, it will not appear in financial statements. Key points to remember. Only monetary transactions, like sales, expenses, salaries, are recorded. Non-monetary events, like employee morale, brand reputation, or a CEO's leadership, are not recorded. This concept ensures uniformity in financial statements because all values are recorded in the same unit, money. Example: recorded in accounting, buying 10 shares for 50,000, since money is involved. paying 10,000 salary to an employee. Not recorded in accounting, a CEO's leadership skills because it has no direct monetary value. Machinery breakdown, only the repair cost is recorded, not the breakdown itself. Shortcut to remember, money, M. Measurable in money, only recorded if money is involved. N, on monetary events ignored. E, expenditures are included. Y, you need money value to record. Money reminds you that only money-related transactions are recorded in accounting. Accounting period concept? What is the accounting period concept? The accounting period concept states that a business's financial performance should be measured at regular intervals, like every 12 months. This helps in tracking progress, taking corrective actions, and making strategic decisions. Key points to remember. A fixed time period is chosen, usually 1 year. Financial statements, like profit and loss account and balance sheet, are prepared at the end of each period. Helps in calculating profit, taxes, and reporting to the government. Even though a business continues forever, going concern concept, periodic evaluation is necessary. Example. Recorded in accounting. A company prepares a profit and loss statement for April 2023, March 2024 to check how much profit it made. Government requires businesses to file taxes annually based on this period. Not recorded as an accounting period. A company randomly checking profits without following a fixed time frame. Measuring financial performance without a specific period, which makes tracking difficult. Shortcut to remember, time. T. 12 months, or fixed time frame. I. Interval-based financial reports. Measuring profits and taxes. E. Valuation helps decision-making. Reminds you that financial reports are prepared at regular intervals to track business performance. Cost concept. What is the cost concept? The cost concept states that assets should be recorded at the original price paid for them, including transportation, installation, etc., rather than their current market value. This price is called historical cost. Key points to remember. Assets like land, building, machinery, furniture are recorded at their purchase price, not market value. Even if market value increases, the asset remains recorded at its original cost. Depreciation is applied over time, reducing the asset's book value. Ensures consistency, reliability, verifiability, and comparability in accounting. Example. If a company buys land for $50,000, it will always be recorded at $50,000 in the books, even if the market price later increases to $80,000. Depreciation will reduce the value of buildings, machines, and equipment, but land usually does not depreciate. Shortcut to remember, CHIP. Cost is recorded as paid, historical value, not market value. I includes extra costs, transport, installation, predictable depreciation over time. Dual aspect concept. What is the dual aspect concept? The dual aspect concept states that every financial transaction has two effects in accounting, one on the assets and another on the liabilities or owner's funds. This is the foundation of double entry accounting. Key formula. Assets equals owner's funds, capitals, reserves. Liabilities, owner's funds equals assets, liabilities. Key points to remember. Every transaction affects two accounts, debit and credit. Ensures that the balance sheet always balances. Based on the accounting equation, assets, liabilities, owner's equity. Helps track the source and use of funds. Example. Mr. X starts a business with $250,000. This money is recorded as capital liability because the business owes it to Mr. X. It is also recorded as cash, asset, because the business now owns this money. Total assets equals total liabilities, $250,000. Shortcut to remember, BALD. B, business has two sides, assets and liabilities. A, assets increase equals liabilities or owner's fund increase. L, logic of double effect. Every transaction affects two accounts. D, double entry system follows this. Bold reminds you that accounting has a double effect, where every transaction is recorded twice to maintain balance. What is the accrual concept? The accrual concept states that income and expenses should be recorded in the books when they occur, not when cash is received or paid. It ensures that financial statements show a realistic picture of a company's financial status. This is different from the cash system, where transactions are recorded only when cash is received or paid. Key points to remember. Record income when earned, even if cash is not received. Record expenses when incurred, even if cash is not paid. Used in the matching principle to link revenue with related expenses. Helps in accurate financial reporting and decision-making. Example: a medical company buys medicines worth $20,000 on March 29, 2014, but pays on April 2, 2014. Under cash accounting, this expense would be recorded in 2014-15 when payment is made. Under accrual accounting, this expense is recorded in 2013-14 when medicines were received. This ensures that the financial records match expenses with the correct time period. Shortcut to remember: RAIM. R occurred when earned/incurred, not when paid. Accurate financial reporting. I, income and expenses are matched with the correct period. 1E, actual payment may happen later. RAIM helps you remember that revenue and expenses should be recorded in the correct period, not when cash is received. Matching concept. What is the matching concept? The matching concept states that revenues and expenses must be recorded in the same accounting period to correctly determine profit or loss. It ensures that the financial results of a business are accurate and reflect the actual performance. This concept is based on the accrual concept, meaning transactions are recorded when they happen, not when cash is received or paid. Key points to remember: revenue and expenses must match in the same period. Helps in accurate profit calculation. Used in both accrual and cash accounting, but differently. Difference between cash and accrual system. Cash system, transactions recorded only when cash is received or paid. Accrual system, transactions recorded when they occur, even if cash is not exchanged. Example: a company sells less than $100,000 worth of goods in December 2024, but receives payment in January 2025. In the cash system, the revenue is recorded in 2025 when cash is received. In the accrual system, the revenue is recorded in 2024 when the sale was made. Matching concept ensures that the expense of producing goods is also recorded in 2024. Shortcut to remember: R, revenue and expenses recorded together. E, exact profit calculation. Matching period of income and cost. Helps you remember that revenue and expenses must be recorded together for accurate financial statements. Realization concept. What is the realization concept? The realization concept states that revenue should be recorded only when it is certain to be received or when it has been earned. Receiving an order is not revenue, but delivering the goods or services is revenue. Actual cash receipt is not necessary. What matters is the right to receive money. Key points to remember: revenue is recorded when earned, not necessarily when cash is received. Helps in accurate financial reporting. Prevents inflating income by recording orders as revenue before they are delivered. Examples: 1. Telecom recharge. If a telecom company sells a scratch card, revenue is not recognized when the card is sold. It is recognized only when the user makes a call using that talk time. 2. Magazine subscription. If a magazine company receives 240,000 from 1,000 subscribers at the start of the year, it does not record the full amount immediately. Instead, it records 20,000 per month, 240 per subscription, 12 months. Rec. R. Revenue is recorded only when earned. Ensures correct financial reporting. C. Cash receipt is not always necessary. REC helps you remember that revenue is recorded when earned, not just when cash is received. What is the objective evidence concept? This concept states that all business transactions must have proof, like invoices, receipts, or cash memos. These documents support accounting records and help in auditing. For transactions like depreciation or doubtful debts, which have no direct receipt, company policies act as evidence. Key points to remember. Transactions must have documentary proof, ensures accuracy and transparency in accounting, helps auditors verify financial records. If no direct document exists, e.g. depreciation, company policies serve as proof. Examples. 1. Buying office supplies. If a company buys a printer for $10,000, the invoice is proof of this transaction. 2. Employee salary payment. The salary slip given to an employee acts as evidence of salary payment. 3. Depreciation on a machine. There is no physical bill for depreciation, so companies follow accounting rules to record it. Shortcut to remember. Pay records transactions properly. O. Organizes financial records. Objectivity in auditing. Actual proof ensures accurately helps you remember that business transactions need documented evidence. Accounting conventions. What are accounting conventions? Accounting conventions are guidelines that help in practical application of accounting principles. They are not legal rules, but are widely accepted customs used by accountants. These conventions change over time as business practices evolve. Types of accounting conventions. Consistency. The same accounting methods should be used every year. Helps in comparing financial statements over time. Example, a company using the straight line method, SLM, for depreciation should not suddenly switch to the written down value, WDV method, unless necessary. Full disclosure. All important financial information must be disclosed in financial statements. Ensures transparency for investors, creditors, and stakeholders. Example, if a company has a pending legal case, it must be mentioned in the notes to accounts. Conservatism, prudence. Accountants should record potential losses but not future profits until realized. Ensures financial caution and avoids overestimation of profits. Example, if a company expects a customer might not pay a SLIA 5,000 bill, it should record a provision for doubtful debts. For materiality. Only significant financial information should be recorded. Small, unimportant details can be ignored. Example, a company losing 500 due to a small error is not material, but a 5 lakh error must be corrected. Shortcut to remember, CFMC, Chief Financial Management Convention. C, insistency. Full disclosure, materiality. C, conservatism. CFMC helps you remember the 4 key accounting conventions easily. Accounting convention, consistency. What is consistency? The same accounting methods should be used every year. Helps in comparing financial performance across different years. If a company changes its method, it must disclose it to avoid confusion. Understanding with examples. Inventory valuation. A company can use different methods to calculate the cost of inventory, such as FIFO, first in, first out. LIFO, last in, first out, weighted average method. Example, if a company chooses weighted average method this year, it should continue the same method in future years. If it suddenly switches to FIFO or LIFO, it will change profit calculations, making it hard to compare past and present results. 2. Depreciation and accounting methods. Businesses have multiple options for depreciation methods. Straight line method, written down value. Bad debt provisions, estimating unpaid debts. Accounting basis, cash basis versus accrual basis. Example, a company using straight-line depreciation should not suddenly switch to written-down value without mentioning it in financial reports. Why is consistency important? Ensures fair comparison of financial reports, prevents misleading financial statements due to method changes, maintains trust and transparency in financial reporting. Shortcut to remember, SAME. Same method should be used every year. A. Accounting consistency ensures comparability. MEM. Methods should not change suddenly. E. Explain any change if necessary. SAME helps you remember the key idea of consistency convention. Accounting convention, what is full disclosure? All important financial information must be clearly shared with stakeholders. Helps owners, investors, creditors, and the public make informed decisions. Ensures transparency in financial reporting. Understanding with examples. Bank loan disclosure. If a company takes a loan from a bank after the balance sheet date, but before finalization, it must disclose this information. Example, if the balance sheet date is 31st March 2014, but the company takes a loan on 25th April 2014, this loan must be mentioned in the financial report for transparency. Bad debts and sundry debtors. If a company lists sundry debtors, people who owe money to the company, it must also mention provisions for bad and doubtful debts, BDDs. Example, if a company expects $10,000 from customers, but $1,000 is doubtful, this doubtful amount should be disclosed properly so that stakeholders know the real situation. Why is full disclosure important? Helps in fair decision-making for investors and creditors. Prevents hiding financial risks that can mislead stakeholders. Ensures trust and accuracy in financial reporting. Shortcut to remember. Open. O. Open and clear financial reporting. P. Proper disclosure of important data. E. Ensure transparency for stakeholders. No hidden information. Open helps you remember that full disclosure equals open and transparent financial reporting. Accounting convention, conservatism. What is conservatism? Be cautious. Assume losses, but don't assume profits. Only confirmed income should be recorded, but expected losses must be accounted for. Ensures financial statements are realistic and not overly optimistic. Understanding with examples. 1. Bad and doubtful debts, BDD. Some customers may not pay back their dues. Businesses set aside money provisioned to cover these possible losses. Example, a company expects $5,000 from customers, but $50,000 might not be received, so $50,000 is recorded as a loss in advance. Valuation of stock. Stock is valued at cost price or market price, whichever is lower. This prevents showing inflated profits in case market prices drop later. Example, if a product costs 500 Skirid, but the market price falls to 450 T, the stock value is recorded as 450, lower value. 3. Preference for written down value, WDV depreciation. WDV method reduces asset value faster than the straight line method, SLM. It prepares businesses for future losses by recording higher depreciation earlier. Example, a machine worth $1,000 might lose more value in the first few years. WDV records this faster than SLM to be cautious. 4. Intangible assets are amortized quickly. Goodwill, copyrights, trademarks are written off as early as possible. This prevents overstating assets in financial statements. Example, if a company buys a trademark for $1,000, it gradually reduces its value instead of keeping it high on paper. Why is conservatism important? Prepares businesses for uncertainties. Prevents overstating profits. Gives a realistic financial picture. Shortcut to remember. Cautious. C. Conservative approach. A. Avoid overstating profits. U. Uncertain losses recorded. T. Take lower stock value. I. Intangible assets amortized fast. O. Only real income counted, unreal profits ignored. Set aside provisions for losses. Cautious helps you remember that conservatism equals careful and cautious accounting. Accounting convention, materiality. What is materiality? If it's important, report it. If it's too small to matter, ignore it. Information is material if it affects decisions of investors, creditors, and other stakeholders. Small, insignificant details can be merged or ignored to keep financial reports simple. Understanding with examples. 1. Small expenses merged. Unimportant expenses are not recorded separately to avoid unnecessary details. Example: a company buys pens and staplers for $500. Instead of showing them separately, they are added under office expenses. 2. Importance depends on company size. What's material for a small company may be immaterial for a big one. Example: a 10,000 loss is big for a small shop, but nothing for a large MNC. 3. Transaction type matters. Same amount can be material or immaterial based on context. Example: if 1,000 is missing from petty cash, it's material, serious. If 1,000 is missing in a 10 crore balance sheet, it's immaterial, negligible. Why is materiality important? Helps in better decision-making. Avoids unnecessary details. Focuses on relevant financial information. Shortcut to remember: M merging small expenses. Importance depends on company size. Same amount can be material or immaterial. Materiality in simple terms. Show 1.5.1 short answer type questions. 1. What are the features of accounting? 2. What are the functions of accounting? 3. What do you mean by assets? Also, explain the different types of assets. 4. Explain the current assets and current liabilities. 5. What is information? What are the purposes of having accounting? 6. What are the branches of accounting? 7. What do you mean by the terms drawings, capital, and insolvent? 8. What do you mean by accounting principles? Give their features. 9. Explain the need and limitations of accounting principles. 1.2 long answer type questions. 1. What do you mean by accounting? Explain its scope. 2. Discuss the advantages and disadvantages of accounting in detail. 3. What do you mean by accounting information? Who are the different users of accounting information? 4. Explain the basic terminologies of accounting in detail. 5. Discuss the different users of accounting information. 6. Explain all accounting concepts and conventions in brief.